Hey everyone, Chris Versace here, Tematica Research. Today is Monday, August 4th, 2025. Hard to believe, folks, we are about a week away from the halfway point of the current quarter. Man, time sure does fly, but as you're probably seeing, stocks are rebounding today from Friday's sell-off. The catalyst here, in part, is the continuation of the current earnings season, but it's also reports that the EU's countermeasures against U.S. tariffs, which were set to take place on August 7th, later this week, that has been postponed for reportedly 6 months, bringing some incremental clarity regarding tariffs, or I should say without much more escalation in tariffs, at least for the near term. But we're also wanting to pay close attention to what's developing, obviously on the front of tariffs with China, but also India, and apparently some movement in conversations with Switzerland. So this continues to be kind of an evolving landscape. Our position on this, however, is that over time tariffs will settle out. Odds are, though, they're likely to be incrementally higher than where they were at the start of 2025. As such, we're going to have to continue to monitor where these tariff rates kind of come out, particularly for key U.S. trading partners: Eurozone, China, Canada, Mexico. Those will be the ones that we tend to focus in on most, but we will want to pay close attention to some others out there, particularly as it relates to U.S. investment. But let's get back to what happened with Friday's sell-off. That was, of course, triggered by the much weaker than expected July employment report. Yes, the figures for July were weaker than expected. Around 73,000 jobs created in full for the month, according to the Labor Department. That was weaker than the 100,000 or so that were roughly expected. But as we all know, it was the big revisions that we saw in May and June, which combined took out 200,000 plus of the jobs that were initially thought to have been created. This, of course, raised kind of alarm bells as to what the true speed of the economy was closing out the June quarter. Again, May, June tied into the second quarter. The July figure, which was what the employment report reported on for the first time, that was for the first month of the current quarter. That understanding that helps explain why we only saw modest revisions to current quarter GDP expectations from the likes of the Atlanta Fed's GDP Now model or the New York Fed's Nowcasting model. The GDP model in particular, Friday afternoon saw the current quarter GDP forecast revised down to 2.1% from 2.3%. Just calling it out because some folks might see those big revisions for May and June and wonder, well, why doesn't that translate into what the Atlanta Fed is showing? The Atlanta Fed's models have kicked over, no longer 2Q, now 3Q, same with the New York Fed and others out there. However, I will say this, that the big revisions in May and June are going to have us really take a much closer look at the next update for GDP for the second quarter. Remember, we got the initial print last week, came in at 3%, much hotter than expected. Typically, we tend to see these things get revised, at least 2 more times. The second revision will be the most meaningful, and I think on the heels of that May and June employment report, the revised May and June employment numbers, we're going to see that 3% revised lower. How much? That's going to be the big question. Could it be 2.5 or slightly less? Possibly. There'll be a lot more other components that factor into that next update than just the employment report. So we'll have to pay close attention to that and see how is the GDP numbers kind of evolving. Remember, the first quarter was a negative 0.5%. Call the second quarter 2.5%, something like that, pretty good. The current quarter is looking, like I just said, to be around 2.1%, but candidly, we're only just starting to get the data. And with that, I just want to spend a moment on data. Just this whole thing about President Trump's reaction to the July employment report and the weak revisions, and how, he's looking to ouster, or I guess he's already ousted the person in charge of the BLS, the figurehead, saying that he will be naming a replacement potentially later this week. To us, the data is the data, and we realize that there are shortcomings in it. We're not very happy that the president is kind of being, so strong-armed in this. It seems to be more of a reaction. Our argument is that, given his time in office, what we're starting to see are economic numbers that reflect the policies and lack of certainty that he's kind of brought into the market, whether it's on the inflation front or the jobs market or some of these others. So we also find it kind of funny that he's telling Fed Chair Powell, you got to cut rates, yet when the jobs numbers are revised to much weaker levels, which would support a potential rate cut, he says, oh, this can't be. So it's a little crazy. But how are we going to be treating the data? Well, we're going to do what we always do, which is we are going to triangulate data. If you think about job creation, there's a lot of data points that you can take a look at, and looking at them in aggregate gives you a much better picture. We also have to understand the puts and takes with different data sets, especially as it relates to job creation data. For example, ADP, their numbers for July better than expected. That's just the private sector. If we take a look at the monthly employment report from the Bureau of Labor Statistics, that has a whole kit and caboodle of information. We need to understand, like I said, the puts and takes there, but it also shows what's happening in the public sector and the private sector, as well as across a variety of demographic cohorts and other job classifications. But we also get employment data through ISM, S&P Global, and their PMI reports for both manufacturing and services. There's the NFIB Business Optimism Index, which also touches on trends in employment. So there's a lot that we can kind of triangulate around. And with that, I'll say this, that when we saw the July manufacturing PMI figures from last week, yes, the headline was in contraction territory and there was slower hiring going on in the manufacturing sector. We will be putting a lot more emphasis on ISM's services PMI, which is out tomorrow, Tuesday, August 5th. Why? Why the services over manufacturing? Pretty simple. When we look at the breakdown of GDP, services is 80 to 85% of GDP. Manufacturing, very small. So we'll not only be taking a look at the services numbers and the trends over the last few months, but we will, of course, be kind of taking a composite view of what those figures are saying, and we'll cross-reference all of that with what S&P has to say. Their July manufacturing PMI was out last week. Their services PMI is also out tomorrow. So again, name of the game here when it comes to data, triangulate. But we will say this, to the extent that the employment market really does start to cool, and we're not saying that it has, but if it does, we could see that kind of get the market a little more excited about potential Fed rate cuts in September. There is a chance coming off of Powell's comments last week that maybe it slips to October, but for argument's sake, let's say September. And yes, the market is thinking now that we could see a September rate cut. If you look at the CME FedWatch tool after Friday's July employment report, the probabilities, again, according to the market, is now north of 80%. But we do know that we have so much more data coming, not just the July services PMI report, but we're going to get July inflation data. We're also going to get a full round trip in August data, and all of that is coming before the Fed's September policy meeting. So I think we have a much, much further way to go. We also could have some other tariff developments as well. Personally, I don't think what we've seen on the way of trade deals is going to bubble much into the July and August economic data. Might likely come after that. Hence the reason that perhaps the Fed might not deliver a September rate cut. It could slip until October. But again, we're going to get a lot more data and we can kind of refine those expectations over the coming weeks. One other thing I just wanted to talk about as it relates to the other big driver of the market, we are in the middle of earnings season. I know it's hard to believe, but we're only 2/3 of the way through the June quarter earnings season. This week, we've got about another 24% or so of the S&P 500 report. So by the end of the week, around 90%. Now, if you've been tracking some of the things that we've been writing over the last several weeks, we've been sharing with you how second half EPS growth expectations, let me get that right, for the S&P 500 have been coming down compared to the first half. If you were to go back into March, they were expected to grow about 14%. Again, second half of 2025 compared to the first half. That has fallen consistently over the last several weeks. About 2 weeks ago, 8.5%. Last week, 7.9%. And coming off of the big tech earnings last week, Microsoft, Meta, Amazon, Apple, that number has slipped to about 6.8%. So much slower earnings growth in the back half of the year. I think we can trace some of that back to questions over the economy, questions over the consumer, consumers opening their wallet, trading down, which of course fits with our cash-strapped consumer theme. But I also think, though, that the impact of tariffs on margins and companies not being able to continue to absorb that is one of the other culprits that we're seeing. So we're likely to see, I think we're seeing some incremental margin pressure. This will become really interesting in the coming weeks when retailers start to report their quarterly results. But I just wanted to get back to the concept of the second half earnings. You know, those expectations have come down. Candidly, we were thinking that on the heels of rising capital spending levels and stronger earnings, particularly out of Microsoft and Meta, that we might have been at a potential inflection point where those second half EPS growth expectations for the S&P 500 could have started to move higher. They haven't. Now, we will want to revisit them after this next slug of S&P 500 constituents report. Remember, we're going from 66% at the end of last week to about 90% at the end of this week. So maybe we'll get that inflection point. We won't really know until about a week from today. But here's the thing. To the extent that we don't see those earnings expectations for the second half of the year move higher, it is going to raise questions about the market valuation, its PE, what is a fair PE given expected earnings growth. I also think some folks were hoping for some clarity as a result of tariffs come August 1st, but obviously we have a little bit of that, but not as much as we would like. And of course, we do know, as I mentioned at the top here, that those rates are going a little bit higher. Just getting back to earnings and what the roadmap for this week is, you know, we, again, tend to take a look at these things from what are companies likely to say as they relate to our various investment themes? Well, with that in mind, we do have Axon reporting after today's market close. We'll be looking at that as it relates to safety and security. We also have Palantir. That'll be an interesting one on AI, especially as they talk about their $10 billion contract win with the Army, which also, of course, lands them into our safety and security theme, not necessarily in the model, but certainly in the theme. We also have AMD reporting. What are they going to say about digital infrastructure, AI, and data center demand? Coming up on Tuesday, we've got Eaton reporting. This will be an interesting one given the flow through of these rising capital spending levels as AI and data center demand continues to be robust. What are they going to say about the electricity pain point and what utilities are doing to address that? Wednesday, McDonald's, Dutch Bros, interesting comments on consumer spending and how that relates to our cash-strapped consumer investing theme. And then Thursday, we've got Construction Partners and Martin Marietta reporting interesting comments for Rebuilding America. We also have CyberArk reporting, which will give us some nice insight into our cybersecurity data privacy investment theme. And then finally, we'll round it out with Motorola Solutions, which will tie us all the way back to Axon and safety and security. So as you can see, folks, there's going to be a lot of stuff happening over the next couple days. No surprise, still in the thick of earnings season, but be sure to come back and check out our thematic signals and other musings, which we think you'll find not only hopefully fun and enjoyable, but a little bit insightful. Thanks for watching.